Hello everybody, my name is Aarth Shastri and today I'm going to be talking about the stock market. The stock market is a platform where shares of publicly listed companies are bought and sold. It allows investors to buy ownership in these companies and enables businesses to raise capital to grow. This means the money that you and I, the investors, put into a company, it can use that money to grow and expand. Now, what is a stock, share, or equity? It basically represents a unit of ownership in the company. When you buy a stock, you uh, own a small part of that company. So you can be called a shareholder or a stockholder. Now, there are two ways to make money in the stock market. There is capital gains and there are dividends. Now, think of the company as this mug. Now, this mug has a lot of pens. So, let's say I buy one of these pens, and the value of this mug increases. So, the value of my pen is also going to increase. This is an example of capital gain. This is where my initial investment of, let's say, $10 has become $15. So I have gained $5 as as my profit. Now this is called as capital gains. And let's take, for example, again the pen from this mug, but this time the value has decreased. So my investment of $10 has become 5. So I have made a loss, and this is called as capital loss. You may also earn money through dividends. What are dividends? They are a portion of the company's profits shared with shareholders or stockholders every month, every quarter, which means 3 months, semi annually, which means 6 months, and annually, which means after 1 year. Now, what determines the value of the stock? It's the market performance, what it is, how it is performing. Like, if it's having more sales, if there is more revenue generated by this company, what's the profit growth? Profit growth is basically the growth compared to last year. So if I make $100 in profit last year and this year I have made 105, so there's a 5% growth in my profit. Now, what determines the value of my stock, or how does my value go up and down? Now, my value could go up when I buy a new product. Now, let's say Apple, which has iPhones, releases a new iPhone and everybody goes to buy that phone. Now, the value of the iPhone stock could increase due to the launch of this new product. Similarly, it can also go down if there are less sales, less innovations, if the company is trying to cut costs by firing people. This means that it's not performing well. Now, is the stock market safe? It's not. The stock market is very volatile, which means it can go up, it can go down. So it is a very risky investment, but it is also very rewarding. When you put your money in, you could lose all of it or you could gain more. But this sounds way too similar to gambling, right? So what's the difference? So basically, when you buy a stock or share, you have done research about the company on how it's been performing, who is the CEO, what's the profit, are they able to pay all of their debts? Debts are basically loans that you take for your business. These are all the criterias which you must see before you invest in a company. Now you will say, if the stock market is very risky, then why should I invest? Because of one very important issue in our world. It's called inflation. Now, what is inflation? Inflation is the gradual rise in the price of goods and services over a period of time. Now, if I go to my local shop and I ask to buy bag of rice. And maybe 10 years back it used to cost $5, but now it's costing 8 or 9. Now this is an example of inflation. So in order to counter the effect of inflation, we need to make sure that our money grows. So we invest in the stock market mainly because it offers an opportunity for our money to grow. So it has growth potential in the stock market. So when you have the stocks, like the pen which I gave as an example earlier, when you buy this pen and you hold it and the value keeps on increasing, let's say you bought it at 10, now it's at 20, then it's going to 25, then it's going to 27. So this is an example of capital gain, and this is the growth of potential of this pen, which you are able to see. And once you sell it, you could sell it for profit. Now there is something called as passive income, which we all need. This is money you get for free without doing anything, or you don't really have to focus for getting this money like you would do at your work. You could earn this money when you're asleep in the form of dividends. So in dividends, when you buy this pen, they will say, okay, we'll give you $2 for you holding this pen. So if this costs $100 and they say we have a dividend of 5%, they will give you 5% depending on what their dividend yield or dividend dates are. So the dividend yield is 5%, and the dividend is going to be giving you is $5 because it's for $105. Quite an expensive pen. Now, how do I not lose money when I invest in the stock market? Now, this is very important to know because stock market could crash. This is what we call as volatility. So best thing to do is to buy stocks of different companies. So for example, if I buy a stock of Cadbury, if I buy a stock of Reliance, if I buy a stock of Tata, I buy a stock of Adidas. So this is really diversified my investment. So this is going to allow me to have a cushion. So if Adidas does not do well, or they are making a loss, then the gain by Reliance or Cadbury could probably counter this, so I don't really lose any money. That's the most important thing at the end of the day. Now we diversify for this reason. And what do you do when the stock falls in value? First of all, there's no reason to panic because the stock falls in value due to normal trades going on during the day. So it's normal for your stock to fall and then tomorrow it's gaining. So it's quite a normal phenomenon in the stock market. And one day if your stock falls doesn't mean that the stock is bad or it's horrible. Like same way, if one day it rains doesn't mean that the whole year is horrible, right? Now if the stock is falling for a very long time and by a big margin, that means there's something wrong. So first of all, it could be a problem in the company. Maybe the CEO has resigned, or maybe the board of directors, the people who control the company, are having disagreements. They're having fights between each other, or maybe they are having unsustainable production methods. Now unsustainable means being able to produce a good or service without causing a lot of harm to the environment, which is very important for us. Now if your stock is falling, you have to first check, is the whole market falling or is it only my stock? Now when would the whole market fall? The whole market could fall if there are wars like the ones which are going on in Gaza and the Russia-Ukraine war. That's very important. So that could be reason why some shops in Ukraine, maybe their stock would fall, or maybe some stocks in Russia, their price could fall, or maybe there's a bad weather, or maybe there are storms. Now if your company loses a lot, doesn't mean that it's always doomed, right? So for example, in the early 2000s there was Amazon, which is now a very well known company. It had a price of $106 and it fell to $6. More than 90% of its value was lost. And that time they only sold books, but then gradually they sold toys, they sold clothes, now they're selling a lot of things, and 20 years later it had reached $3,300. So patience is extremely important in the stock market. Now there is a very well known investor whose name is Warren Buffett, who is one of the richest people in the world, and he's the only investment banker or investor who is at who is making billions, who is not a businessman. Now, as an owner, when you buy a share, you can control the company partly, because there are a lot of people who own shares, and it's not just that the company that you have or the company which is there is giving shares. Only 100 shares exist. Then if you buy one, you would be like a very well you'd be a very important person. That's the main idea. But companies, they issue billions of shares. So now they do this mainly because they want to get more money. Like if there are billions of shares and you each of them is 100, so the total equity they could get if they sold all their shares would be $100 billion, which is an extremely huge sum of money. So now, because there's 8 billion people in the world. Now let's say each person bought a share. Let's say there are 8 billion shares and every person bought a share. Now how can you distribute the decision making process of the business in among 8 billion people? It's not possible. So that's why what companies do, they usually give the person who owns a huge sum of huge value of those shares. Or like Elon Musk in 2022 with Twitter, he had bought 9.2% of the company through the stock market, and he was the largest singular investor. So what does that mean? That means you, as the person, you are Elon Musk and you bought 9% of the company, and everybody else, there are different sorts of people, nobody owns more than maybe 1%, and you own almost 10% of that company, so you are quite important. Now when can you control the company? So now you can control the company when you have 50% of the shares or the equity capital. And now there are two different types of stocks, shares or equities, which are called as common stock and preferred stock. Now what's a common stock? A common stock is the normal stock we buy on the stock market, where you can vote. It gives you voting rights. Whereas in preferred stock, you don't have the authority to vote. But why should I take a preferred stock and why should I take a common stock? Now the advantages are, in common stock you have a more chance of getting capital gains. Now like we had discussed, so preferred stocks, their value usually does not increase by a big margin, but if you have a common stock, the value could increase exponentially, maybe 1,000% if you have picked a one in a million kind of a company. But normally the value increases way more than the preferred stock. Now you will say, okay, now a common stock sounds very nice, but what does preferred stock have? Preferred stock receives dividends before the common stock. So this is extremely important, because some people only care about the money and not really they want money in their hands very fast, so they could go for this preferred stock. But normally when you have a stock and let's say it increases by 5%, so the common stock would increase by 5%, but if I have a preferred stock, it could increase by 1% or 2%. So the chance of capital gains on it is very low. But of course, when the value increases very fast, it could come down very fast as well. So common stock has more risk than preferred stock. So common stock has more capital gains than preferred stock. Now you may be slightly interested to buy some stocks. Now you would ask me, where are they traded? Where do you get these stocks? So these stocks are traded on the Bombay Stock Exchange or the New York Stock Exchange, which is also known as Wall Street. How do